So welcome to this video. In this video, we are going to solve the December 2011 question, which is NPV related. So what we'll do is first we'll start from the required, okay? Then we'll move on to reading the question. So the required asks you to calculate the NPV and advise whether the investment is financially acceptable. Then it asks you calculate the IRR of the investing in the machine and advise whether the investment is financially acceptable. And the question moves on to explain the meaning of sensitivity analysis. So this is a theory question. Calculate the sensitivity of the investment in the new machine to a change in selling price and to a change in discount rate, and comment on your findings. So A, B and C2 are the problem ones. So that is what we are going to solve now. So we'll start from the question. So we'll read the question. Warden Co. plans to buy a new machine. The cost of the new machine is payable immediately. That is, the payment has to be made on the start of the year. That is the 0th year, and it is worth 8 lakhs. And the machine has an expected life of 5 years. Additional investment in working capital is 90,000 and will be required at the start of the first year of the operation. So again, it is the 0th year. At the end of 5 years, the machine will be sold for scrap, with the scrap value expected to be 5% of the initial purchase cost of the machine. So if you have bought for 8 lakhs, 5% of it is going to be the scrap value. The machine will not be replaced. So if the machine is not replaced, the working capital will be released. So that's about the first paragraph. The second paragraph is production and sales from the new machine are expected to be 1 lakh units per year. Each unit can be sold for 16 per unit and will incur a variable cost of 11 per unit. Incremental fixed cost arising from the operations of the machine will be 1,60,000. So they have told you about the operational angle of the machine. So here Warden Co has an after-tax cost of 11%, which it uses as a discount rate in investment appraisal. So this is your discount factor. The company pays profit after profit tax 1 year in arrears at an annual rate of 30% per year. Capital allowances and inflation should be ignored. Okay, so the tax is going to be paid in a 1 year arrear at 30%, and there is no like tax benefit or a depreciation benefit or inflation in this problem. So this problem is a very straightforward problem. So we'll start. So we'll always start NPV problems with particulars, and we'll also set to solve this problem in terms of thousands, so that it is like easy for us. We'll also have a working note column here, okay, and we'll also start from the 0th year. So 0, 1, 2, 3, 4, 5 is the life of machine, and 6 is the tax year. So taxes is in arrear, so we'll have it as a 6th year. So we'll start. So the first number is going to be sales. So sales is going to be how much? In 0th year, we are not going to have any sales. In first year, we are going to have sales. Sales is going to be 1 lakh units, but we'll convert it into 100 units. We'll cut off the thousands, okay, and multiplied by the cost. Selling price per unit is 16. So we've got our sales value. Just take that number for 5 years across. We got our sales value. So the next one is variable cost. So variable cost is going to be the same kind of an application. So we'll have again equal. We'll take 100 as the units multiplied by the variable cost per unit. It is 11 per unit. So we'll take 1100 and we'll spread it across 5 years. So the next one is fixed cost. So here they say fixed cost is going to be 1,60,000 per year. So if you take 1,60,000, we'll cut 3 zeros in thousands and it's going to be 160. So we'll copy that and we'll just paste it. And for variable cost, as it is a cost, what we'll do, we will convert that number into a negative number. So 100 into minus 11 we will have it, so that it comes to a negative 1100. So we'll copy that and we'll paste across. So we got all these numbers. So if we solve these numbers, we are going to get profit before tax. So this is going to be our profit before tax. We'll just sum it. Okay. Why we sum it? Because the income are in positive and the cost are in negative. So we got our profit before tax. We'll just do the same for the other numbers. So we got the same number. So we have tax now, and tax is at 30% here. So we'll have it as 30%. But tax is in arrear. So what we'll do, the first year tax is going to be paid on the second year. So we'll take this cell as a reference. But what we'll do, we'll have 30% number. As the tax is a negative number, okay, what we'll do is we'll mark it as a minus symbol so that it comes to a minus number. So we'll take this number and we'll spread it across to 6 years, from the second year to the 6 years. So if you count, it's going to be 5 times 1, 2, 3, 4, and 5. So we got our tax also. So now we will get something called as a profit after tax. We get after tax. So you can simply sum the number. This and this, you can just simply sum it. You got 340. Do it all the way for all the 6 years. So we got for all the 6 years, okay, the tax and everything. So our this paragraph is over, okay, and tax part is over. So we'll go to the first paragraph, which is about the new machine. So we'll take it as machine cost. So machine is bought in which year? Machine is bought in the 0th year. So that is a negative 800. And there's also a scrap. Whenever you do machine, you also take the scrap into account. So the scrap value is going to be 5% of 800. So it's going to be 800 into 5%. Okay, that is a inflow. As we sell the scrap, it's an inflow. So we'll take it here. So that comes to 40. So whenever you do the machine cost, always do the scrap with it. So the next number that we have still is working capital. We'll take it as WC. So working capital has to be invested when? He says it has to be invested in the first year of operation, at the start of the first year of operation. So at the start of the first year of operation is 0th year. So 90 we'll put it here, and it will be released when we sell the machine, it is released. So 90 we'll put it here. But why it is released? Because they say the machine will not be replaced. Okay, so as the machine is not replaced, the working capital will be released. So that's about the 90 here. So we've got all our cash flows. So what we'll do, we'll have the word called as cash flow, and we will sum up all these cash flows. So we have another sum from where? From here, from profit after tax till our working capital. We'll take all the numbers into account and we'll close. So we'll do the same for across the 6 years. We got our answers here. So that's about our cash flow. Still we have some step. We have discount factor at 11%. So what we do with this, the discount factor for the 0th year is 1. Okay, the discount factor is always 1 for the 0th year. From there on, it falls. How it falls? 1 divided by, okay, 1 point, whatever is the discount factor. So whatever the discount factor is, in this problem we have 11% as a discount factor. So we'll take it as 1. Okay, so take the previous number and divided by 1.11. Do the same for all the 6 years. So you neatly got your discount factor. I'll repeat again. So take the 0th year as 1, and then in the first year reference the first cell number. Okay, that will be usually 1, that will always be 1, divided by 1 point the discount factor. The discount factor is 11% here, so we take it as 1.11. so you got this formula. You copy paste this formula, so that each formula will, what they will do is they'll reference the before cell. So for second year they reference to the first year, for the third year they reference to the second year, like that each number refers to the before numbers. So that's how it works. Okay, if you are like confused suddenly with whether these numbers are correct or not, check the with the discount factor table which is available in the exam. So you got these numbers. So next one is to find out the discounted cash flow. So discounted cash flow is a simple number. Multiply your cash flow into the discount factor. You got your DCF. So in some books it's called as DCF, in some books they call it as PV, present value. So we take it as DCF. So the last number is NPV. So NPV is very simple. Sum all the discounted cash flows from here to the 6th year and close the bracket. So you got your NPV. So NPV of 104 is the right answer. So whenever you have written this, okay, next to it also write the suggestion. Suggestion is accept the project, because if you're going to just indicate that accept the project, okay, suggestion is accept the project, you will get a half a mark. So don't miss that half a mark. That's very easy to get. So we'll move on to the next question. The next question is calculate the IRR. So IRR is a little bit complicated. So what happens is we have to do the same sum again once more. So we'll have a heading called as IRR and we'll bold it. Okay, so for IRR what we have to do is this NPV has to come to 0. Till that we have to work out the problem. So we'll copy this entire table, okay, except for the suggestion. We'll copy the entire table and we'll again reproduce it. Okay, because if you're going to like copy half of it, then the values you might not get the values properly. So it's better to get the full table and copy it. So you just have to focus on only one line here. Okay, the line is a discount factor table line, the discount factor. So our job is like this. The NPV has to go to a negative number or 0 number. If it goes to 0, that is your IRR. If it goes to a number which is below 0, okay, to a negative number, then you have to find out you have to put a formula and find out the answer. So what we'll do is we will take any number which is higher than 11. So take something like 5% higher. So we'll take 16% and we'll try to do it. So we'll alter this formula here which we've created. The discount factor is 11. We'll take 11 and we'll take it as 16. Okay, so that's what we did. We have taken 16. Close it. But only this year has changed. This year will not have changed. So what if you want, you will just show you. This year is still 1.11. This year is 1.16. So what you do, you copy this cell and paste it across to all the cells. So now effectively you have got all the numbers have changed. You see your NPV has gone to negative. Okay, if it has gone to exactly 0, that is your NPV. But mostly I think 16% or 15.5% would be the NPV. 15% or 15.5% would be the NPV, but we have to work it out. There's no other go. Okay, so we'll have the IRR formula. So I'll do the IRR formula here. IRR formula is low discount factor plus open bracket NPV at low discount factor divided by again a bracket, again NPV by at low discount factor minus NPV at high discount factor, close the bracket. Okay, so this is the second part of the formula, and the third part of the formula is multiplied by high discount factor minus low discount factor, close the bracket. So that is what gives you the answer. So we'll do them each separately like how we have done here. So low discount factor in this table is, we had 11%. With that 11% we have to add some other number. MPV at low discount factor is 104. So we'll take that number 104. So divided by again 104. Formula has a minus, and the number that we had is also a minus, so minus 2.7, close the bracket. Okay, as there are two open brackets, we should have two closed brackets, so we closed it, and we'll go to the last part of it. The last part is multiplied by high discount factor is how much? 16. Low discount factor is 11. So we have finished it. So this is only for your sake to explain. In exam you can just work it out and in the Excel sheet and directly give the answer. So now what we'll do is, I will work out this side. So if I put a equal symbol here, I will get the answer. Okay, multiplied by 5. So I will get an answer here. So this part is again the same 11 plus. So again 11 plus, we'll multiply these numbers, or we'll type it 0.9747 into 5. We got 4.87. So we'll add both. We'll add this and again this number. Hopefully we'll get an answer. No, as it is not. Okay, the answer comes to 15.87. That is the IRR. So we finished the IRR problem here. The question asks you to advise whether it's financially acceptable. To do that, we have to compare the cost of capital. Cost of capital is 11%. Okay, and our IRR is 15.87. So just have a suggestion. Suggestion would be, as IRR is higher than cost of capital, we can invest in the project. Okay, so that's about the suggestion. We got the answer. So we have still one more problem. The last one is sensitivity. Calculate the sensitivity of the investment in the new machine to a change in the selling price and to a change in discount factor. So we'll start with the sensitivity. So the sensitivity has a formula. So the formula is sensitivity. Day, Vaishya. Day. Sumar. Sensitivity to selling price. So the formula works like this. It's NPV divided by present value of sales after tax. So that's about the present value. That's about the sensitivity. So we know the NPV number. The NPV number that we calculated originally was 104. But what we don't know is the present value of sales tax, so that we don't know. So for that we have to work it out. So to work it out, we'll copy this entire table. We'll copy our entire NPV table and we'll just bring it down. We'll work it out here. Okay, so we need to work out sales, we need the tax, we need the tax, we need sales after tax, and then we need the cash flow, then we need the DCFs and all these numbers. So what we'll do, we'll bunch them together. So we'll start. So first we'll find out the tax on this numbers. So tax is at 30% on some number. Which number? On the sales number. So we got that one. So we'll just copy and paste across the 6 years. Done. We'll next total these numbers. So the sum function is for this year, the sum function is from this year to this year. We close the bracket. You've done it. No. So we'll just add both these numbers. We'll add this one and we'll add the tax. Okay, so we got it. And now we'll add the other 6 year numbers. We got them too. And we have the cash flow. Okay, so cash flow is done, discount factor is done, DCF is done. We got the NPV, so we don't need the cash flow number. We'll shift all these numbers once up. So for multiplication purpose, we have to multiply the profit after tax into this number. Okay, so that is all done. So we'll just copy it and we'll paste it across 6 years. We got, and finally we got the answer. The answer comes to NPV of, so we can't say that as NPV, that is the present value of sales after tax. So we got this number. So we'll just type the number here, 4315. Okay, so what is our sensitivity? Our sensitivity will be, numerator is 104 NPV divided by 4315 is our present value of sales into 100. That will give us a percentage number. So 2.4 is the percentage. So this is our answer. Okay, so this is our answer. So we have got it. So we have got that. But still the question is not ending. There's still one more element here. The question asks you, what is the sensitivity to a change in selling price and to a discount factor? So discount factor is nothing but IRR computation. So we'll take this and we'll again compute it. So we'll have it here. Sensitivity to discount factor. So here is also, it is 2. So, but the formula doesn't work like this. The formula works like the IRR minus the cost of capital, okay, that divided by again by the cost of capital into 100 will give you the answer. That will give you the answer. So we'll work it out here. So the IRR of this problem was 15.8. So first we'll put that minus the cost of capital in the sum was 11%. So first put this in a bracket, okay, divided by 11 and into 100 will give you percentage, and you got an answer. The answer comes to 43.6. So what does this tell you? See, this tells you that the sensitivity of selling price, okay, is like very small. Even for a 2.4% change in the selling price, the NPV will become 0, but it will take 43% of cost of capital to change, okay, from 11% to 15%. It takes 43% to change from this factor to that. So which one is like very, for which one of these NPV is like very sensitive? NPV is like very sensitive for these, okay, when compared to the IRR. So that is how the problem works. So NP is like very sensitive to the selling price when compared to the discount factor. Okay, so you just have to write that. So NPV is sensitive to the selling price and not much to the discount factor. Okay, or you can say NPV is very sensitive to selling price or not much to the discount factor. So this can be your suggestion. Okay, but don't write such a small suggestion. Write it in at least some uh, like 2-3 lines so that you'll get the marks. Okay, so we have come to the end of our video. Hope you have understood it. Okay, so wherever you want to highlight, just put them and put them bold. The bold options are available in your exam also. So this will tell the examiner that you know which are the key numbers. Okay, which are the key numbers, and always highlight the suggestions that you have made. Okay, so this answer looks very neat, and try to do the same answer in your with your computer. Okay, and try to do it. So thank you very much for watching this video. We'll meet in the next video.